Debt capacity analysis. This presentation addresses what is debt capacity analysis, why is it important, and what does it entail. Debt capacity analysis is this assessment of how much debt a government can afford. It involves looking at things such as legal limits, how much the economy, i.e. the tax base, can support in debt, and the government's philosophy on the amount of debt it wants to incur. It's important to look at debt capacity in relationship to other goals and plans. We've discussed before that governments will have master plans and capital improvement plans. These will identify high priority capital infrastructure projects that need to be financed. And so it's important to look at the magnitude of those projects relative to the financing sources, including debt. It also is important to take a comprehensive look. A government looks at its own debt outstanding, but also needs to think about the constituents. What other financial burdens do this community bear? Are they characterized primarily by low-income residents? They're going to have a harder time paying taxes to support debt. Or are there other overlapping governments, such as school districts, that have heavy debt burdens and heavy tax rates? So it's important to take a comprehensive look. And then it's also important to develop debt policies that are acceptable to the community. Some communities really are very conservative and do not want to use debt, where other communities recognize they've got significant growth and they need to issue debt in order to expand their infrastructure. Okay, let's look at legal limits. Legal limits can be established either in a government's constitution and or through statutes, through legislation. In some cases, there are limits on debt that can be outstanding, expressed debt as a percent of property wealth or debt per capita. There also can be debt limits expressed as debt service, which is a payment of principal and interest, as a percent of operating revenues. For example, a government may say that its debt service cannot exceed 5% of its revenues. There also are other kind of legal limits, such as limits on revenues, and those are important because they affect the ability of the government to support debt. There are also other legal provisions, such as bond covenants, and these are agreements that have been made in terms of issuance of prior debt. For example, in the official statements that are used to inform investors, the government may promise to do certain things. For example, when you have revenue bonds, bonds that are secured by a specific revenue source, a government may commit to a particular coverage ratio, which is net operating revenues divided by principal plus interest. So if you had a water system, you would take the water revenues minus the cost of running the water system, and that would be the net operating revenues. And the government might promise that that will cover principal and interest by 2.5 or 3 times. And there may be also other legal provisions in the bond restrictions. Another important component is looking at the economic analysis. Look at tax and the revenue base. What are trends over time? Has there been a growth, for example, in market value / assessed value? How reliable are the revenues? Is the community's revenue base fairly diverse, or is it very heavily dependent on the headquarters of a particular company? How have tax collections been doing? Are people paying their property tax bills on time? Or are there delays? Are people really struggling? And then what is the future outlook? Is there new development occurring, or does it look like there's a downturn in the economy? It's also important to do the financial analysis where you look at financial trends. And this would include looking at revenues and expenditures and seeing if revenues are sufficient to cover expenditures. If not, that's going to constrain the amount of debt a government can issue unless other action is taken. Also, as we've we'll discuss bond rating companies like to see unreserved fund balances, funds that are available in case there's an economic downturn or natural disaster or some other unforeseen occurrence. And so, to the extent that the government has very little unreserved fund balance, that also may mean the government's going to have trouble supporting debt and getting good bond ratings. Governments also need to do just like bond rating companies do and look at the existing debt burdens. How much debt do they currently have outstanding? And then also look at other liabilities, such as unfunded accrued pension liabilities and OPEB liabilities, which is other post-retirement benefits, i.e. health insurance for retirees. Has the government been keeping up with these liabilities and setting aside money, or is it going to have to play catch up or have a major problem in the future paying pension or retiree health insurance? And then governments also typically look at benchmarks where they compare their finance, those various financial indicators, to those of other governments, as well as comparing to bond rating criteria. In terms of benchmarks, the ones that are the most commonly used are indicators of debt outstanding burdens. And as I indicated previously, governments often look at debt per capita or debt outstanding as a percentage of personal income or as a percentage of market value of property. And so this is sort of like individuals. You may say you have a lot of debt outstanding, but relative to what? If you're rich, that debt may be manageable. If you're poor or unemployed, that debt may present a real problem. Governments also look at debt service benchmarks. Debt service, remember, is the payment of principal and interest. And the most common one involving debt service is to look at debt service as a percent of operating revenues or expenditures. And so if that debt service is 3% of operating revenues, that's much more manageable than if it's 18 or 20%. And similar with your own debt payments, debt that you have to pay monthly, either on a car payment or college loans or mortgage, what percent of that is that of your income or your ability to pay the debt? Governments also look at their debt burdens relative to other governments. Moody's prepares state medians that can give states guidance in terms of how high their debt burdens are. A lot of local governments will compare to other nearby communities. For example, if this was hometowns debt analysis, they see that their debt services percent of operating revenues is close to 5%. And to gauge if that's high or low, they've looked at their peers, comparable cities within the same state and approximately same size, and they look relatively in the ballpark, a few being a little bit higher and a couple being a little lower. It's also important to look at what are the projections for future debt service. If you identify in your capital plan that you have the need for a certain dollar amount of debt financing, then you can calculate what the annual debt service would be using the equal PMT Excel function I talked about in a previous presentation. And then it's a good idea to look at this graphically. So let's say I have a local government, a particular city, and in year one, they're below their debt capacity level, which they have established as 5% as the target debt service projections as a percent of operating revenues. So their existing debt, which is the blue, is below the 5%. And if they don't issue new debt, then it continues to decrease below that 5%. But let's say they looked at the new debt needs and they analyzed what that would mean in terms of annual debt service and added it to the debt service for their existing debt. And that's shown in red. And as you can see, that puts them over their debt capacity level of the 5%. So then they would have to decide whether they need to not do as much debt, i.e. not finance as many projects, or if they're willing to go over the debt capacity level they have established. And this can be a challenging conversation to have, but it's one individuals have, right? Can I afford to borrow for a new car, or is that going to make my debt unmanageable? So in conclusion, we've talked about the importance of doing debt capacity analysis, analyzing to what extent a government can afford additional debt, and that takes into account things as well as such as legal limits, looking at debt burdens, looking at debt of overlapping governments, looking at pensions and other post-employment benefits, i.e. retiree health insurance liabilities, and then also looking at the preferences of the community. Is this a community that is willing to issue debt and pay for that debt, or is it a more conservative community that tries to do things out of savings of current revenues as opposed to going into debt?